Capitalism is unstable. The government must help get people back to work. The economy needs to be stimulated. Slogans are misleading. The fact is, most periods of severe unemployment were produced by the government's mismanagement rather than by any inherent instability of capitalism. For example, in the Great Depression, the Federal Reserve System exercised its responsibility so ineptly as to turn what otherwise would have been a moderate contraction into a major catastrophe. That's how Milton Friedman starts his chapter on monetary policy in his book Capitalism and Freedom. Monetary policy is about who controls the supply of money, or who actually prints the dollar bills, euros, yen, or some other currency, or if the money supply is a commodity like gold or silver. Most people don't know or care what monetary policy is, but they should because it has a drastic effect on the economy and their livelihoods. Milton Friedman says, look, the goal should be to have a stable monetary policy, as stability enables people to grow the economy. But the question becomes, how do you go about achieving a stable monetary policy? Well, typically there is one of two answers. One is to use gold and silver as money, and the second answer is to have some group of experts help direct the economy by turning different knobs and dials. Milton Friedman says both of these answers suck, and here's why. The first option, a gold and silver system, in theory works great. The total amount of money is determined by how much gold is mined, and once it's refined into coins, people can spend it. The system is simple and straightforward, has the least amount of middlemen, and so preserves the maximum amount of individual freedom. Historically, though, it's never really worked like this. Even when gold and silver are used as money, there's always some kind of paper currency also. For example, let's say a society starts off with 100% gold and silver as money. Pretty soon afterward, someone, whether it be a private business or the government, will basically create a piece of paper that says, I know this is just a piece of paper, but it represents actual gold that I have in a vault. Inevitably, the government gets involved to both prevent people from defrauding others by creating pieces of paper for gold that doesn't actually exist in a vault, and eventually so they can have the irresistible power of being able to print money to themselves. Thus, in practice, almost all gold standards have become mixed with both paper currency and actual metal. And while some people may look back to when America was on a gold standard as the good old days of monetary policy, we have to remember that to the Americans at the time, the system clearly didn't work. There were financial crises in 1873, 1884, 1890, 1893. William Jennings Bryan's infamous Cross of Gold speech was given in 1896. The Panic of 1907 finally crystallized this ill feeling into action, and 6 years later the Federal Reserve would be established. Milton Friedman's conclusion is that an automatic commodity standard, or gold and silver standard, is neither a feasible nor a desirable solution. But if we thought a gold standard had its issues, just wait until the experts get their hands on things. The second option is an independent central bank, which also works great in theory. Advocates will often say that due to how unstable a capitalist economy is, we need to be able to adapt to unforeseen circumstances. Therefore, we need a group of experts given various powers to turn different knobs and dials to keep the economy moving along smoothly. While this sounds great in theory, in practice, the results have been pretty terrible. Before the Federal Reserve, the US had panics and recessions, but nothing like the severe depressions after its establishment. Even when you give the Federal Reserve the benefit of the doubt, says Milton Friedman, on the basis of extensive study of the historical evidence, they undoubtedly screwed things up even more. Just to prove his point, Milton Friedman dives into how badly the Federal Reserve just completely messed things up during the Great Depression. Firstly, he says, most people think the Great Depression started with the stock market crash of 1929. And while the crash makes for a great opening scene to a movie with stockbrokers jumping out of windows, hanging or shooting themselves, is not really when it started. Really, it started just a little prior to the crash. And while the crash certainly didn't help things, there was nothing that signaled that this crash would be the beginning of a major depression. The proverbial crap only started to hit the fan once the bank failure started. Due to the nature of how banks are interconnected, when one bank failed, it made it more likely that other banks would fail, which in turn made it more likely that other banks would fail. This domino effect started the economy going downhill, and people started to panic. Back then, if your bank failed, you lost all the money you had in the bank. This panic caused people to withdraw their money, which caused more banks to fail, which intensified the downturn. This was the moment the Federal Reserve was meant for, built for, designed for, and they dropped the ball. In December of 1930, when they should have done something, they did nothing. In the middle of 1931, when more bank failures began, the Federal Reserve decided to still do nothing. Later in 1931, the Federal Reserve decided to do something. They promptly responded to requests of people wanting their gold, which only intensified the downturn. Finally, in 1932, the Federal Reserve bought some government bonds, which kinda helped a bit. The collapse resumed shortly thereafter, finally culminating in FDR's banking holiday of 1933. But all this didn't stop the Federal Reserve Board members from high-fiving each other and writing in their annual report of 1933 what a great job they did helping to avert something really bad. Cue the Great Depression. Now, current proponents of the Federal Reserve will usually respond with something to the effect of, yes, we know the Fed failed during the Great Depression, but we got real experts in charge now. They got all these equations and stuff. They know what they're doing. To that, Milton Friedman has one more thing to say. The Great Depression is a testament to how much harm can be done by mistakes on the part of a few men when they wield such vast powers over a monetary system. Any system which gives so much power to a few men whose mistakes, excusable or not, can have such far-reaching effects is a bad system. So if neither a gold standard or a central bank works, then what's Milton Friedman's endgame here? What's his solution? Well, good old Milton proposes a simple one. Essentially, we need to go back to one of our founding ideals of being a nation of laws and not men. Rather than have some group of experts be in charge of stuff, simply create a rule that makes the stock of money increase every year by a certain percentage. Creating a rule would drastically reduce the amount of power any experts have in the economy and would preserve the maximum amount of freedom for the individual. That is the solution, according to Milton Friedman. Thanks for watching this video. If you haven't read Capitalism and Freedom, I really recommend it. In it, Milton Friedman covers this topic in much more detail than I ever could have hoped to do in this video, but also topics including poverty, discrimination, social welfare, and a lot more, and how they relate to capitalism and freedom, obviously, the title of the book. So if you like this summary, you can purchase the book from Amazon. If you use the Amazon link on my website, I get a little kickback, which helps me make more videos like this one. Simply go to thenickwright.com. If you want to be emailed when I release a new video, then sign up at thenickwright.com/email. Thanks.